Welcome to Money Talks Leaders Listen, the podcast where financial news meets your financial leadership and financial acumen development. Hi, I'm your host, Sophia Melanie of the Debt Demolisher TV, and I'm thrilled to be back for another groundbreaking conversation with you. In today's episode, we will discuss a sensitive topic that often causes concern and uncertainty among investors and everyday households, and that is navigating market dips. Believe it or not, market dips are a very important part of investing, and understanding how to navigate them can help you stay focused on your long-term financial goals. So if you're ready to go into this conversation, let's dive in. The Debt Demolisher TV with Sophia Melanie. All right. I know you all are probably have been on pins and needles since this last conversation around the debt ceiling and really trying to find out what's happening with this negotiation. If you haven't found out by now, there has been recent talks from the House that an agreement has been reached between them and President Biden. However, there are a few steps that has to happen in order to ensure that whatever those terms are can be finalized and the bill can be passed. Once this happens, then we can continue our conversation to talk more about the debt ceiling. However, there are still some uncertainties that just might impact the economy, which is why I want us to have this conversation today. So to kick this conversation off, let's start off by understanding what market dips are. So a market dip refers to a temporary decline in overall value of the financial markets, such as when stock prices drop. These dips can occur due to various factors like economic events, geopolitical tensions, or even changes in investor sentiments. So we know that these recent conversations around the political tensions around the debt ceiling, the back and forth between Congress and the executive branch, it's been a lot going on. And so you may be seeing that there could be some potential for the market to still suffer from some dips. So I want you to be mindful of looking at what's happening inside of the stock market and seeing how people are reacting to these conversations. I want to say this because I've said this before on several occasions, that it's important to remember that market dips are a natural part of every investment cycle. So the stock market experiences periods of both growth and decline. So it's crucial to maintain a long-term perspective rather than being swayed by the short-term market fluctuations, because we know that that is bound to happen. And in order to not be swayed, you really have to have a strong mindset. And so since we know it's important to maintain a long-term mindset during market dips, let's talk about how to embrace a long-term mindset and the significance of having a long-term perspective. What I really want you to commit to memory is this. A long-term mindset helps you focus on the bigger picture. Over the long run, markets tend to recover and deliver positive returns over time. So by staying invested and not succumbing to the short-term panic of what's happening around the economy and in the market and in the news, you can give your investment time to grow and even potentially benefit from the eventual market recovery. A way that you can overcome the feeling of short-term panic is by diversifying your resources as well as your investment portfolio. Diversification is a key strategy for managing risk during market dips. This is how diversification can help investors during turbulent market periods. Diversification involves spreading your investments across different asset classes, different asset industries, as well as geographic regions. In a nutshell, an asset class is a grouping of comparable financial securities like stocks, bonds, money market instruments, cash, commodities, real estate, cryptocurrency, and those things along those lines. The diversification strategy can help reduce the impact of market dips on your overall financial portfolio. When one investment is experiencing a downturn, others may be performing well, which would offset the potential losses. Now, during those periods of economic downturn, it's imperative to mind your emotions so you won't react out of fear. Emotional decision-making is a common pitfall during market dips. So, question for you. What practices have you put in place as an investor to avoid making impulsive decisions based on emotions? Here's what you have to realize. You must recognize in advance that emotions can cloud judgment when it comes to investing. So during market dips, fear and anxiety may lead to panic selling, which would lock in your losses if you end up selling too quickly, because the market will end up recovering from that temporary dip shortly after your fear-based move. So instead, investors should stick to their predetermined investment strategies and avoid making drastic changes based on short-term market movements. Now, please understand this. Market dips can present opportunities for investors. So don't believe that just because a market occurs that you're out of the loop. This is the time where you could actually begin to leverage those downturns. Remember in prior conversations that I've shared on the Debt Demolisher TV that you have to position yourself to take advantage of the down. Before I go into some other things in terms of how you can do that, I want us to talk about rebalancing for a minute. So rebalancing your investment portfolio during a dip can be extremely beneficial to your portfolio if you keep your consistency with it. So let me explain what rebalancing is so you know what it entails. Rebalancing involves simply adjusting your investment portfolio on a recurring basis to maintain your desired asset allocation. And it doesn't have to be done multiple times a month or multiple times a year, but it should be evaluated and performed at least once a year, especially depending on where you are in your investment stage, whether that be wealth accumulation or if it be wealth preservation. During market dips, certain asset classes may experience larger declines than others, and this could cause your portfolio to become imbalanced. So by rebalancing, you can sell some of the investments that may have performed well and buy more of those that have dipped in value. At this point, you would effectively be buying low and potentially benefiting from the subsequent market recovery. I know this may seem scary and you may feel like you have no clue what to do when it comes to these actions to perform, but this is why staying informed about the market and seeking professional advice are so important, especially when navigating these market dips. Staying informed about market trends, economic indicators, and industry news could help you make informed decisions during these market dip times. That, coupled with consulting with a qualified financial advisor, can provide even more valuable guidance tailored to your specific financial situation and goals. Their expertise and experience can help you navigate market dips with more confidence and make informed decisions based on your long-term financial objectives. I want to share a few more things you could take advantage of to help you in your investing journey. One is dollar cost averaging. This is another strategy that can really benefit you during market dips. Let me briefly explain how dollar cost averaging works and its advantages. In essence, dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the market conditions. So during market dips, this strategy allows you to purchase more shares or units when prices are lower, which lowers your average cost per share over time. This helps smooth out the impact of short-term market fluctuations and can potentially enhance your overall returns down the line. Now, if you're wondering, how do you ensure you can continue to practice dollar cost averaging? This is where budgeting and maintaining your emergency fund will be crucial. I stress the importance of this a lot on the Debt Demolisher TV, so many of you know this, but for those of you who may be new to the platform and you're just hearing me for the first time, you're going to hear me say this a lot. Pay yourself first so you can save yourself later. During market dips, it's crucial to have a financial safety net in place. An emergency fund provides you with a cushion in case of unexpected expenses or financial setbacks. By having 3 to 6 months worth of living expenses set aside in a readily accessible account, you can avoid the need to liquidate investments during market dips, potentially reducing the impact on your long-term financial goals. So you already know the saying, stay ready so you won't have to get ready. Market dips remind us of the importance of diversification, having a long-term perspective, and maintaining discipline during turbulent times. Market dips can also highlight the need for regular portfolio review, risk assessment, and adjusting investment strategies as circumstances changes. By learning from these experiences, you as an investor can become more resilient and better equipped to navigate future market fluctuations. As we conclude this episode on navigating market dips, remember that market volatility is a normal part of investing. By embracing a long-term mindset, diversifying your portfolio, avoiding emotional decision-making, practicing self-education, and seeking professional advice, you can navigate market dips with more confidence. Stay informed, stick to your investment strategy, and remember that time in the market is often more than timing in the market. Thank you for joining us today on Money Talks Leaders Listen on the Debt Demolisher TV, a place where we explore the latest financial news, decoding complex market trends, and offering insights that can help you make informed decisions about your financial life. We hope this episode has provided you with valuable insights and strategies to navigate future market dips. Remember, investing is a journey, and staying committed to your long-term goals is key. Don't forget to subscribe to the podcast for more insights on personal finance and economic topics. Until next time, stay financially informed and empowered. Remember, your financial prosperity awaits you, and so does your financial sanity. You already know what I'm going to tell you to do, and that is what? Get to work. All right, guys. Bye. The Debt Demolisher TV with Sophia Melody.